This order never reached the matching engine, not because of a bug, because it broke a rule. Under MiFID II, every order has to clear pre-trade risk checks before it can touch the market. Let's see exactly how FIXFlux enforces that, in code. MiFID II's regulatory technical standards require investment firms to have pre-trade controls that stop erroneous or disorderly orders before execution. In practice, that means a handful of concrete checks. Is this order too large in value? Is the price a fat finger typo? Does it push a client's position past the limit? And is this client already juggling too many open orders at once? FIXFlux implements all four. Every limit is an environment variable with a sane default. Read once at startup. Nothing is hard-coded. Compliance can tighten the fat finger percentage or the notional cap for a specific deployment without touching a single line of Python. Just a redeploy with a new value in Docker Compose, or in Kubernetes, a new config map. Check all runs 4 checks in a fixed order and stops at the first failure. Notional first is the order's price times quantity over the cap. Then, fat finger. How far does this price deviate from the last traded price for the same symbol? Then position. Would filling this order push the client's gross or net exposure past its limit? And finally, a simple head count. Is this client already at the maximum number of open orders? Any one rejection is enough. The order never reaches the second check that would have mattered less. Every single order gets a decision logline, approved or rejected, whether or not anything is wrong. If the checker approves, the order is recorded as an open position and forwarded to risk-approved orders. If it's rejected, FIXFlux builds a rejected order event carrying the exact reason string from the checker and publishes it to risk-rejected orders. Same code path, same structured log format either way. That consistency is what makes this auditable. Let's break it on purpose. This order's notional value is 1.5 million, over our 1 million limit. Watch risk-rejected orders. There it is, the order, unchanged, with a reason field that reads exactly like the string check notional built. Notional exceeds limit, with both numbers spelled out. No guessing why it failed. The same rejection surfaces here, in the Rejected Orders Only panel, queried straight out of Loki. In a real deployment, this is the panel a risk desk keeps open. Every rejection, every reason in one place, without grepping container logs. Notice what didn't happen. The matching engine never saw this order. It was never at risk of executing. That's the whole point of pre-trade risk. The check has to happen before the trade, not after. In the next video, we'll look at compliance, a service that doesn't block anything, but builds a tamper-evident audit trail for every order that does get through.